Hi guys, this is chapter 11 on taxes. We're going to practice filing taxes, which is very appropriate since it's tax time. The learning objectives this chapter are computing sales taxes using a rate table in percents. We're going to compute assessed valuations of property taxes based on assessed valuation, and then compute tax rates in percent, compute property tax payments involving special assessments, prorations and exemptions, and we're going to make basic computations to determine taxable income for taxpayers who use the standard federal income tax form, a 1040, and we're going to do the same thing to determine the tax liability for taxpayers who use the tax form 1040 as well. So starting out, sales taxes. A sales tax is a government levy or a charge on retail sales of certain goods or services. Retail sales taxes are a combination of state and local taxes. Obviously, Montana is a state that does not have sales tax on retail. However, there are other taxes such as tobacco taxes and fuel tax that are assessed and added into that retail. Retail sales tax are a combination again of the two. An excess tax is a tax assessed on each unit. In some states, both the excess tax and the general sales tax apply on items such as gasoline, cigarettes, alcoholic beverages. So in a state that has sales tax, your gas tax is what I like to call it. The tax on gasoline is going to be double. Cigarettes are going to be double because there's already a tobacco tax in there, and then you have to pay the state tax on top of it. So in Montana, you're just paying one tax for those. In South Dakota, you would pay two. Figure 11 is sales taxes, 4% if on anything from 1 cent to 12 cents, there's not going to be any taxes on. 13 cent to, for 4% sales tax, it's either usually 4 or 5% sales tax. 0 to 12 cents on 4%, there's none. You don't have to pay any tax. But if it gets to be 13 to 37 cents, then you're going to have to pay 1 cent, and 38 to 62 cents, 2 cents, and you just keep going from there. And on 5% sales tax, the 0 cent or the 1 cent to 9 cent is there's no taxes due, and so on. If you go through that chart there, it just shows how tax works on items up to $1. To compute sales tax and local and total sales amount, basically we take and multiply the taxable sales amount by the tax rate. So whatever our total is that we are buying at that time, we multiply it by the tax rate and get the total sales tax amount that we're going to pay, and then add that to the total. So here's an example. If taxable merchandise of $63.39 is sold in a state with 5% sales tax, what is the amount of tax and the total amount to be paid? So the amount of tax, we take that $60.39, multiply it by 0.05, which is our 5% sales tax, and we get a number, 3.0195, which ends up being $3.02. That total amount to be paid, we add that $3.02 to our $60.39, and the total that we're going to pay is $63.41. An example B, a customer living in a city with 6% sales tax and a 1% or 1.5% city tax, purchasing a refrigerator regularly priced at $850, was given a 10% discount. There's a lot going on here. So we have customer buying an $850 refrigerator, given a 10% discount. State tax is a 6%, city tax is a 1.5%, and there was a delivery charge of $45. So what was the amount of tax and the total cost to the buyer? So the first thing we figure out is the discount amount, because we're not paying sales tax on anything but the price. So we're not paying sales tax on $850 because we got a discount. So first of all, we got to figure out 10% of $850. So we multiply $850 by 10%. And we get $85. So we know that we're not paying $85 of that refrigerator. So the price after the discount, we take our $850 minus our $85, and now we're paying for a $765 refrigerator. So that is what we will take and base our sales tax on. So what we can do, since we have a 6% sales tax and a 1.5% city tax, is we can add those two together. You add your 6% plus your 15 or 1.5%, sorry, and multiply that by $765, and you're going to get $57.38. And then you add that and your delivery to the total cost, and you get a sales total of $867.38. So assessed valuations and property taxes. A property tax for a business is a tax on real estate or other property, such as machinery owned by the business. The assessed value taxes are based on value, known as and determined by the representative of the local, state, or government. So they're done by a lot of times appraisals. Assessed valuation is based on the current market value of the property, or what the property could be sold for. And if you don't know what that is, which most people don't, then you have it appraised by someone that is state appointed. An example D, the Kinsey family lives in a town in which the assessed valuation is 60% of market value. The Bailey family lives in a town in which assessed valuation is 75% of market value. Each home has a market value of $260,000. So the valuation of each home is going to be different because of the assessed valuation. This is the same thing as like if you live in the desert, valuation is not very high, but if you live in the hills, like in the Black Hills, valuation is high. If you live on land that isn't very valuable, your valuation is going to be low. And if you live in a place where it's like on the beach where it's high, then you're going to pay a higher percentage. So in this case, each family owns a $260,000 home. One is at 60% valuation and one is at 75% valuation. So they take that price of that home, $260,000, and multiply it by each respectable valuation to get the assessed valuation of each home. So the Kinsey home, $260,000 times 60%, which is 0.60, and you get $156,000 home, and the Bailey family has a $260,000 home. Multiply that by their 0.75, 75%, and they have a $195,000 home. In example E, the Lee family and the Kelly family live in a town in which the assessed valuation is by law set at 80% of market value. They live in identical houses and have a market value of $220,000. The Lee family added an enclosed deck costing $10,500 and a family room costing $32,000. The Kelly family made extensive repairs and repainted the house a new color at a total cost of $15,000. What was the assessed valuation on each home the following year? So the Lee home, $220,000. Then we have the Lee family, they said, enclosed a deck. So we add that $10,500 to that. And then the $32,000 family home, or family room. So the total is $262,500, and we take 80% of that, which is $210,000. And that's what their assessed valuation is. The Kelly home, however, repairs and paintings are not considered improvements, only building on and adding on to the value. So the repairs and the painting are considered to be just maintenance. So they just take the $220,000 and multiply it by the standard 80% and get a valuation of $176,000. Tax rates, percents, and mills. So a percent is a tax rate found by dividing the amount of money the government unit needs to raise by the assessed valuation of the particular unit. And a mill is a tenth of a cent, which is a thousandth of a dollar, and it looks like 0.001. So percents, we're finding the tax rate, the amount of money the government needs to raise to assess a valuation. So in example F, we have the town of Lakeside has total assessed valuation of $570 million. The amount can be raised by taxation, or the amount to be raised by taxes throughout the community, is $9,775,000. So they had to figure out what rate to tax people at to get that amount of money. So they take the 975,000, divide it by the 570 million, and they're going to get 0.0175. Move that decimal 2 places to the right, and you have 1.75%, and that rate is usually written as 1.75% of value, or $1.75 on each $100 value. You probably won't have to do much of this, but it's nice to know just in case. Example G, if a property in Lakeside is assessed for $160,000, what is the tax? The tax can be found by multiplying the assessed amount by the rate. So you just find the rate, 1.75%, and multiply that by 160,000. You got a $2,800 property tax. Figure 11 is income and outlays. Basically, the pie charts show the relative sizes of major categories of federal income for the fiscal year of 2009. So the top one is government income, and the bottom one is government outlays, which are expenses. So expenses, outlays is another word for expenses. You can see where our government income consisted mostly of borrowing to cover our deficit. So we borrow money from the government to pay the government's debt, which seems to not make a whole lot of sense, but that's where 40% of our income comes from. 25% of our income comes from Social Security, Medicare, and unemployment, retirement taxes. Personal income taxes consists of 26% of our government income. Excess customs, estate taxes, gift taxes, miscellaneous taxes, all are 5%, and corporate income taxes are 4% of our government's income. Our government expenses consist mostly of 34% Social Security, Medicare, and retirement, 22% national defense, foreign affairs, and veterans, 21% to special programs, 10% to physical, human, and community development, 5% to be interest we pay on the debt, and then 2% to law enforcement and general government. Just an FYI slide. This is a 1040 label section. It's basically for your tax return, U.S. individual income tax return. What you really need to put is, if you're married and filing jointly, you need to put you and your spouse's social security number. If it's just you, you just put yours, and then put you and your spouse's name and address. You have to put whether you're single, married, or, well, single, married, filing jointly, or married, filing separately. If you're head of the household, if you're a qualifying widower with dependent child. They're pretty nosy. They want to know everything. You have to put your exemptions. So everybody's going to have one exemption, which is yourself. If you have a spouse, you'll have 2. Any kids, you write them down as dependents. Anything you have in form of W-2, so your salary, wages, etc. Taxable interest, if you made any interest over $400, I believe, you write it down. Unemployment compensation is taxed, and then you combine them all together to get your income, and then you're going to subtract an IRA deduction, and you go through and you basically file your income taxes this way, going through the steps to see if any of them apply to you. They tell you which lines to add together, and then subtracting your exemptions, taxable income. If you have any miscellaneous income, you'll have to put those in there too. The standard deduction for most people right now is, if you're single or married filing separately, your deduction is $5,700. If you're married filing jointly, or if you qualify as a widower, you get a deduction of $11,400. Head of household, $8,400. This is a tax rate schedule. We saw those last chapter, so this should be not anything new. But if your filing status is single and you make over, let's say $8,500, which is over $8,375 but less than $34,000, then the tax is $837.50 plus 15% of the amount over $8,375, and so on. We did those last chapter. So for the Form 1040 illustrated in the text, the tax is computed as follows. So line 43, they had a taxable income of $35,800, and then they were married filing jointly. So tax on the first was 10% of $16,750, which is $1,675, plus 15% over that, which was their $35,800 minus $16,750, leaves them over $16,750 by $19,050, and we multiply that by 15%, and that is $2,857.50, and we add that to the standard deduction of $1,675, and you get a total tax of $4,532.50. In example M, we have Dave, filing head of the household, has adjusted gross income of $110,000. His deductions are $700 to Goodwill, $900 to the church, $8,200 interest on his mortgage, $3,300 state taxes, and he claims 2 exemptions. We want to compute his federal tax. So we take his adjusted gross income, subtract his deductions, and then we get $96,900. Then we minus his exemptions, which add up to be $7,300 based on the schedule, and then taxable income is $89,600. So then we have to figure out how much he's going to pay in taxes. So from the schedules, he had a household. The tax on the first is $45,550. So he has a standard of $6,235 plus 25% of anything over $45,500. So he had $89,600 taxable income. So you subtract that $45,550 and you get $44,050. So that has to be multiplied by 25% to get your $11,012.50. So you add those all together, and you get $17,247.50 that you pay in taxes if you're Dave. This is a 1040 credit section. This is what your accountant does, by the way. They're the ones that are going to fill all this stuff out for you. But if you study, you can do it on your own. This is a credit section, so if you have any child tax credits or if you apply to any of those, you can see instructions and get guidance there. But if you have any tax credits, you add those. So that is added, that $1,000 tax credit is added to line 47 through 50, and you get a total of $3,532.50 in deductions or tax credits. Same thing. So example N, we have Eric and Audrey Vaughn. They file a joint return. Their adjusted gross income is $52,900. And they take a standard deduction. They have 3 children, aged 12, 15, and 17, and claim 5 exemptions. Compute their net federal income tax after credit. So they have $52,900. Their joint standard deduction, based on the chart in your book, is, or on the slides too. If you don't have your book, it's on the slides. $11,400. So after we minus our 5 exemptions, which our standard deduction for an exemption is $36.50, we multiply that by 5 to get $18,250 and subtract that. So we got a taxable income of $23,250. So from our Schedule Y, our standard rate for the first $16,750 is $1,675. Now we need to add and take 15% of anything over that amount. So we're over it by $6,500. Take that amount by 15% and we add $975 tax onto that. Add that 975 to our 1675 and we're going to get $2,650. And then we minus our child tax credit. They have 2 children, so they have a tax credit of $2,000 and they ended up paying $650 in taxes. And there are your terms for review. And that concludes chapter 11.